What are stocks and how can you use them to make money? Let's break it down. Well, stocks essentially represent ownership of part of a company, often referred to as shares. Sometimes you'll also see this referred to as equity. And some companies are public or private. So a public company, you can just go buy their stock on the New York Stock Exchange, meaning you can go open an account with Vanguard or Fidelity or Charles Schwab or something and buy that stock. But there are some companies that are private, like Chick-fil-A, and you can't just go buy their stock. That's how a lot of companies are, but they tend to be the smaller companies. But a lot of large companies are public companies. Private companies, oftentimes they're like the companies that you see on Shark Tank or something, where they're not particularly available for you to go invest, but if you had a lot of money and you set up a meeting with the owner of the company, you might be able to sell or buy part of the company. It's also important to note that stocks historically have outperformed many other investments in the long run, including bonds, oftentimes real estate, but there can be exceptions where real estate's done well in particular areas or over the long run that there's been times where it's been really competitive. But stocks are a really good way to get everybody who's working at a company to work for you. And now they're working to raise that stock price and then increase the amount of value that you have in your account so that you can end up being better off and getting your money working for you. And that can benefit you in two ways. People buy stocks expecting that they're going to increase in value. That's one way. And that's where you expect that I'm going to buy the stock at $100 and I'm going to sell it later for $200. And now I've made 100% rate of return and I've doubled my money. People also buy stocks expecting that they're going to receive a dividend as well. So for example, if a company had a stock that was worth $100 and they pay out a $5 dividend, then you would get a $5 check for that. It's important to note that when a company pays a dividend out on their stock, that it's going to lower the price of that stock by the amount of the dividend. So if it was a $100 stock and you have a $5 dividend, that stock is now worth $95. So that money isn't just magically printed out of nowhere. So it's going to lower the stock value because the company is now worth $5 per share less than it was before. But you can have choices with what you want to do. So you can either have it reinvested where it's put back into that account and now you own more than just one share, you might own part of a share. Or you can have that money paid back out to you and you just say, I'm just going to cash that $5 check and take the advantage of the fact that they're paying that out. So why do companies issue stocks? Well, they're essentially trying to raise money or capital, typically for future expenses, to try to help reinvest back into the business. And they might sell 20% of the total amount of available stock and put that out to the public and let that be the amount that's publicly traded. A lot of times the private investors or the owners still typically own a majority share of that stock, but this can vary from company to company and how much they want to sell. Now there's two types of stocks. First, there's common stock, which is the most common type of stock, where you own just the shares of the company and you get to vote at different shareholder meetings. There's also preferred stock, which is less common, where you don't get to vote at shareholder meetings, but you do have a higher claim on assets if the company goes bankrupt. Now, most times if a company goes bankrupt and you just own common stock, you just see that stock value just dwindle away and no longer have the value in that account anymore. But you can protect yourself from this by investing in mutual funds instead. A mutual fund stops you from just investing at one company at a time to then be able to invest in tons of companies at the same time. Now, something like this is the S&P 500, where you own shares in 500 of the largest companies, but you own just partial amounts of them for as low as $1. If you want to learn more about mutual funds, click on this video here, and thanks for watching and follow for more finance tips.